Hello and welcome to the latest Retire Well episode with me, Matthew, and as always I'm joined by Joe. Today we're going to be thinking about the psychology of investing and specifically how that impacts people approaching retirement and in retirement. So it's really quite a hot topic with the increased market volatility that we've got with Trump currently in the tariffs, but also it's important for us to think long term about those people who are investing and the psychological decisions that we've got to make. So for me, I think retirement is both financial and psychological, and very much it's about getting those two things to align for someone to, take that jump and enter retirement. I recently had someone on the phone who said, I've got my notice, I've put my notice in to finish, but is now the wrong time to retire? Should, because of Trump and the market volatility, I change my decision? So what do you think about that in relation to the psychology of investing in retirement?
I mean, I think if we're looking at sort of investing over a longer term, a short term blip like this in the market, which hopefully it is and it most likely is, shouldn't really affect when you hand your notice in and when you go to retirement. Yeah. I'm sure you've spoke with that client at length over the financial plan, that it's sustainable, that we've essentially forecast that this stuff like this could happen when looking at drawing down on it, and it's just part of the investor journey essentially.
Yeah, definitely. I think the most important thing there was someone hasn't woken up one day and said, I want to retire. It's been an ongoing process, and they, as well as have been getting their pension and their finances robust, they've also been thinking about the psychology of retirement and thinking, what will I do with my time? I'm ready to finish. I might have enjoyed my job, but now I see more value in spending time with grandchildren, going on holiday, the retirement bucket list. So when we think about loss aversion, which is one of the common things that people think about with pensions and retirement, it's essentially saying if your pension goes up by £50,000, how much extra pleasure do you feel from it? And if your pension was to fall by that same £50,000, how much pain do you feel? And studies have shown that people feel the losses a lot more, and they think about them more, and it dominates their thought process. So certainly, when we're thinking about a long-term plan, we're factoring in that element that, losses can be more painful than the gains. For a long-term plan and a long-term investor, again, you can tolerate the fluctuations, but very much in the short term, if you look at very short-term figures and data, that can be the stuff that can be a bit overwhelming.
Yeah, and I don't really think it's helped by the media's focus on negatives either. The media loves a bad news story as opposed to a good news story. I mean, just recently with regards to the tariffs, the Telegraph are a pretty upstanding newspaper, I'd say, compared to some that are available. They ran a headline of the FTSE plunges right after the tariffs were imposed, and it had actually dropped by 1%, which, to be honest, is a pretty normal day in investment markets. And then a week later, when it had gone up to 6.5%, there wasn't as many headlines of the FTSE soars to sort of recover the thing. There's very much more of a focus on the negative, which obviously causes more panic, and a lot of the time can worry you more than what's actually happened within your portfolio.
Yeah, 100%. And I think when we think about is now the right time to retire, I am never basing it on short-term things like Trump and the tariffs. I'm thinking about, okay, are you psychologically ready to retire? Can the assets that you've got also sustain you over the long term? And that's the important bits coming together, not the, we've seen something like Trump dominating the market, so can we put it off for a little bit? And I think that comes into it where you're right, the media can definitely get in people's heads. I've had a few clients who've only been invested for a short period of time, and they've seen things from the Telegraph actually where they've gone, okay, I've read that annuity rates have hit a 15-year high, so maybe I should have got one, but maybe have I missed the boat because now my investments have fallen slightly? Well, actually, when you look at annuity rates over the last 15 years, annuity rates over the last 3 years have been broadly the same. So where does the Telegraph get their 15-year high from? Again, they're trying to sell newspapers, sell clicks on the internet, again, the same way that the news wants watch the programme and go, oof, I better follow the rest of this episode.
Yeah. And I think this, again, it comes back to what we've talked about a lot on the podcast of having a solid financial plan. If you've sat down with a financial planner or even done it yourself, one of the first things that we talk about in an initial meeting is your capacity for loss. How much can you lose and the financial plan still meet your requirements on a long-term basis? So for a lot of our clients, that might be 30, 40, even 50% of the investment at one point, because the sort of the underlying income and withdrawals that we're taking is seen as sustainable.
And I think that's where someone says, I can afford to carry on the same holidays, the same trips out for food, the same shopping at a supermarket, but I don't want to. So that's the element where the capacity for loss in the plan can match it, but the human nature goes, oh, I don't want to, that sounds scary. Again, I think people who see a loss that might equate to a year's worth of salary or 2 years worth of salary, again, that can be very emotional to think, how much work did I do for that money versus how quickly did an external market factor change it? And I think that can have a real impact. For me, I think it does come down to that. Do you feel richer when something goes up? And therefore, do you feel poorer when it drops? And I think it's that bit that when we've been having reviews and catch-ups with clients recently, we've been talking about this, and really there's enough capacity for loss in a plan to carry on with the same holidays, to carry on with the same spending, and just to carry on enjoying retirement. Because if you stop that spending and compromise your retirement, again, you've got that clock of time ticking down, and you might then say, okay, when I feel like I've got a lot of spare assets, it might be in my late 80s, and I might not want to do the same things that I wanted to do in my late 50s and my 60s. So it's that opportunity cost that potentially becomes the problem.
Yeah, and just I suppose a last thing to talk about with regards to the media and the focus on the negatives is something called confirmation bias, which is essentially if you're thinking something and you're worried about something, and then you go online to try and find things that meet that and try and confirm how you're feeling. So social media's a big one. If you're in sort of social media, you're only within a certain sphere that are all thinking one way, you can start thinking like that and perceiving the world. So I think it's always good if you've got a financial planner to talk to them and get a different perspective, or even just other people that are not necessarily in your immediate group, to get a different idea of how they're thinking. I think one thing there, whenever we see market downturns, we get a number of clients that come through that are worried about the market, and they might say, do we need to be doing anything? Do we need to be changing anything? Yeah. Some might say, oh, well, maybe I'd feel better in cash, which isn't necessarily the right thing to do. But on the flip side of that, during market downturns, we also have a number of clients that get in touch that go, well, this is actually a good time to buy and put more money into the market.
Definitely. I think that's right. I think it was only today that I had a client come in who was rightly thinking about Trump and short-term volatility, and that was what was the key bit for them coming into the meeting. But actually, as we finished the meeting and going away, they were left with the idea of, okay, they've got assets that are actually growing over time, they've got secure income, they're actually in a position where there's a risk that they don't spend their money in their lifetime. So I've left them to go away with the headache of what are they going to spend their money on, and what is their top objectives for the next few years, almost that retirement bucket list, which is a completely different flip from the conversation that they thought they were going to have based on Trump, and almost going, should we spend less? Where actually for them, it's a should you spend more? And that's where you try and find your balance in retirement. There's always an excuse not to spend. When you're working, you're spending someone else's money, you're spending the salary. When you retire, you've accumulated those funds, you then retire and you then start to draw down and spend your own. And we see it from that point of view, where some people then start to get a bit nervous and a bit scared to spend money because it feels real, and it feels like, okay, well, if I spend £2,000 this month and then £2,000 next month, the human nature says, okay, how many months will this pot be depleted? But actually, that's where growth, long-term planning, other incomes like state pension comes in, and that's where we build in those sort of cash flow models to say, what does retirement look like, and give people the confidence to go through it and spend their own funds.
Yeah, and you mentioned there, just with regards to growth, we've talked a lot throughout the podcast about the importance of long-term investment, especially when you compare it to cash rates. I've seen there was a specific article, I can't remember what newspaper it was now, but it was one of their sort of personal finance gurus that said he only invested in cash rates and cash is king, whereas we know in reality that cash doesn't outperform investments on a longer term basis, and even inflation, you're going to lose your sort of spending power on that. So I just thought it'd be good to spend a little bit of time looking at long-term investment and the importance of staying invested.
Yeah.
There's various things that you can look at with regards to that. When I'm speaking to clients in first meetings, a lot of the time I speak to them, I call it the 75-25-14 rule, which is
catchy.
Catchy. I'm working on a name for it, but essentially what that is, it looks at the S&P, which is an equity market, and it says 75% of your investor journey it's going to be going up, 25% of the time it's going to be going down, and in any one year you're going to lose about 14% of your investment of sort of a drawdown. And I think that in a first meeting quite helps them set their expectations of, yeah, most of the time it's going to be going up, but there are going to be sort of significant drawdowns on it throughout the year.
Yeah, I was talking to a client recently who said, this isn't what I thought investing would look like. So I thought, okay, that's interesting. What did you think it was going to be like? And they said, okay, I thought it would go up by 3%, come down by 2%, go up by 3%, come down by 2%, go up by 3%, come down by 2%. Every time adding value, whereas when we talked about recent performance especially, it's been a bit more snakes and ladders. You get a run, we saw the end of last year, we saw investment markets do quite well, then Trump caused a bit more volatility, we're on a snake, we're coming back down, again you wait for that next ladder. What we know over the long term is there's more ladders than snakes, but when you look at short-term investing and when people are, saying, okay, well, 3 years is still short-term, I might have hit more snakes than I have ladders. And I think that's the way to, for people to think about it. I'm not reliant on markets going up. I know they will over the long term, but if they go sideways, if they go down slightly, a financial plan can work. And I think that's when thinking about the data and thinking about the short-term returns is useful. And when we've looked at this and lots of analysis has been put into it, this is a normal year. We see the S&P 500 come down again over the last 20 years. We've seen 94% of the time, we've seen a correction. So we've seen the S&P 500 fall by more than 5%. Again, the idea of that happening, people might say, oof, that sounds scary. I don't want to do that. But actually, how many times has that market finished positive and how many times has that driven returns? And that's why we stay invested during these periods. And that's the real importance of that long-term journey. And volatility also adds value because people can make money during volatility, which is why, again, we invest for the long term.
Yeah, I think that importance of remaining invested is the key bit there. A lot of people feel like they're safer in cash in times where there's a volatile market. But I mean, in the last 30 years, if you were to remain completely invested, you'd have X amount. If you were to miss just the 10 best days during that period, you'd actually have half your investment returns. And a lot of people might think that the best days come when the markets are going up. It's not actually the case. The 78%, I think, is what we looked at. 78% of the best 50 days come when the market's been going down for a significant period of time or when it's just started to go back up again.
Yeah, definitely. And I think that's where, we're not the greediest financial advisors. So when people say cash is king, they're right in relation to short-term spending and having liquidity. So we would never say, have no cash. You want to have the right level of cash for your short-term spending and your buffer. If the car breaks down, you want to be able to pay for it. Again, if you have issues with roofs or anything like that, you want to pay for it before the insurance pays out. But when was the last time that someone had to pay for £20,000 or £40,000 without a few weeks' notice, probably a few months' notice? So again, you want cash in the short term, but for the long term, that's when we know investments do add value. And I think, again, the data that you're talking about there is why people don't panic and move the 100% of their pension into cash. Again, that's where people talk about paper losses. When someone says my pension fell in value by £50,000 in a day, all that's happened is the underlying companies, the underlying assets have been revalued down, and that's a one-day thing. Again, next day, next 6 months, whatever, how will that change? As long as you haven't done anything with it, you're still invested in those same companies and you've got that same potential for growth. The thing I say to people often is, how often do you value your house and how often do you know how it's fluctuated? Most people aren't valuing their house, daily. They're definitely not doing it very often. Some people might look at it on Zoopla once a year. Again, most people probably only look at it when they're looking to sell. So again, that's the element of how do you really see the security in the asset, and looking so often, does that really almost help for that conversation?
Yeah, I mean, I think with sort of regularity of checking, some people literally do log in daily and look at their investments.
Some people look in multiple times a day.
Right, yeah, exactly. And if you're doing that, you've got pretty much a 50% chance of it being up or down. And the longer time periods that you take between looking at it, the more likely it is to have gone up. So if you sort of checked every month, that increases to 60% a chance of going up. Every quarter, almost 70%. So I suppose just from sort of a mental perspective of sticking to that long-term plan, it helps to check a little bit sort of less regularly.
Yeah, and on the other side of things, you can have people who see the media and see the volatility and say, I therefore won't check my pension values. I think that's probably going the other way. You're better off not fearing the unknown. You're better looking and checking on that basis, but it's like a sweet spot. How often do you look at your bank to say, how much have I got in cash? Again, that might be the time that you say once a month or once a week, but you shouldn't really be looking as regularly as that. When things are happening in the marketplace, like Trump and like the tariffs, people might be looking a little bit more just to see what's happening. But ultimately, if you know you've got a long-term plan and you've got capacity for loss built in, then you've got the time to ride through these shocks. And like Joe says, you can then capture the best days. Again, if you think about the people who were panicking and people who don't have support of a financial advisor who might have been looking to move into cash, when Trump came and announced the pause on the tariffs, they were probably thinking, or if they hadn't already done it, had a finger on the button to say, I'll put this into cash because I'm uncomfortable with it and I don't like seeing the volatility. At the point that they've done that, the S&P 500 was up by more than 9%. Then the FTSE opened the next day quite positively, and they would have been sat there in their cash thinking, I've sold my companies of the world and I'm sat with cash. Now I've got to make the hard decision of when do I put my cash back into those companies of the world, knowing I'm paying a higher value than when I sold, and they have really locked in a loss in the same way that someone who is just investing in the same companies and has the same exposure, they haven't locked in any losses, they're just seeing a paper loss.
Yeah, and I think that's something that can help with that. Yeah, you've mentioned having your cash fund for emergencies in terms of if something goes wrong with the boiler. The other side of that, which we do, I guess it's almost like an emergency fund for the market. So if we've got a client that's drawing down on their pension, we'll put 6 months of their pension in a cash-based fund, which essentially means if the markets are on a sort of a period of downturn, we're able to sort of keep the majority of their investment invested while drawing down on the cash portion, which gives that invested portion time to recover, which is really what you want to happen there. And that'll probably help people that maybe do have the one to go into cash sooner rather than later. It almost gives you a little bit of waiting time to outweigh the markets.
It's fighting that sequencing risk. The idea that if you were to sell an investment, once a month to pay out your income, if the markets are going down, you've got that sequencing risk of being forced to sell more units to do it. By having that cash buffer, the income strategy, you can then say, okay, well, I've got a period of time, 6 months in that example, to carry on taking the income, and then I'm allowing the investments to recover. Again, I think people have that approach, and we've had some clients who go, if I don't need the income during a time of market volatility, I'll turn it off. Again, that can be brilliant, and that can work really well with a flexible strategy. But equally, people who need the income shouldn't be cutting down on their day-to-day spending, because again, that's what the plan's got built in. So I think that's when you want people to worry less and stick to a plan, and that's where I think a financial advisor can come in well to say, look, we've seen a global financial crisis, we've seen Brexit, we've seen Russia-Ukraine, we've seen Liz Truss, we've seen COVID, we've seen lots squeezed into a short period of time, and actually what's come through that, the companies of the world, they're still making profits, they're still invested in your pensions, and they're still driving things forward. I was talking to a client recently who works at Caterpillar, a local factory, and their share price year to date was down by about 20%. When I talked to that individual about the company, they were still making the same trucks, they were still sending them around the world, they still had an order book that was full, and they still expected more orders to come in. So ultimately, when that person was chatting through that company, they were actually saying, well, actually, why is it worth this? Again, it's an overreaction based on market forces. And when things settle down and those fear indexes calm down, that share price will come back up again. That was their view, and it makes sense. And when you look at that in a basket of a pension with, say, 10,000 examples like Caterpillar, that's why you don't press the panic button, and that's why you trust the long-term plan.
Yeah, I completely agree. I think that leads quite nicely on sort of another one of the behavioural biases that we can speak about that isn't necessarily market related, but is mental accounting. So this is essentially explained as you almost segment your individual funds that you've got. So you might have had some cash which you was given by your grandparents, and it's been in premium bonds for 10 or 20 years, and you essentially treat that differently than cash that you've got in your current account, even though it might do exactly the same thing. And I think that one can be a bit of a harder one to look at, especially from an emotional point of view, because you might have an emotional attachment to those shares that you've inherited or something like that. But I think that's more so about conversations around how they can actually be used and if there's any detriment to holding it. But equally, when we speak to people, it's, again, Matthew says it, we're not greedy financial advisors in the fact that if there is something that you've got an emotional attachment to and it helps for you to keep it, you can. It's just about understanding sort of the wider implications of that.
Yeah, definitely. I think the same thing happens there with a legacy psychology to a pot can also happen between husband and wife's assets. You can almost say, from a financial planning point of view, we think of them as taps and they can be used to create the household income. But sometimes people go, oh, well, that's my pension, so I draw that down before I touch the ISA or before I do this. Again, we think about it as how much income do you need and what's the most tax efficient way to do it. But often people have gone, oh no, well, we should use his pension before we touch my ISA because they've built up an ISA over the years, whereas an employer's paid into the pension. So sometimes we're unpicking those mental biases to almost pull that together and explain how we can use them. But when it comes to the psychology of inheritance and other things, I think you're right. It's a case of if it's right for the individual, it's completely fine. I've seen low risk investors who have one specific company that they hold, and you go, well, why? And you say, oh, well, that's because my husband worked there, so I want to keep a hold of those Greg stocks or that bank stock because a family member worked there, and therefore I'll hold them for as long as I'm alive because that was what they it wanted me to do. Again, sometimes as part of the financial plan that can make no sense, but if it makes sense financially for them and it doesn't have a detriment to them, then we can almost accommodate it and work with it.
Yeah, I think this can also be applied to your client scenario at the start of where clients perceive the money's coming from. So, as you said, someone might be a little bit more hesitant to retire because when they swap going from a salaried income, it feels like spending the employer's money every single month. And even though when they switch to the pension, they're still going to be receiving the same amount of income each month, and we've seen that it's sustainable, some people might struggle and feel like they're spending their own money as opposed to someone else's money.
I think we see that completely. We see it sometimes when, the income streams swap. So you might say an employer was paying your salary and you were spending the money. We see that flip into decumulation, and someone goes, well, I know I've accumulated this pot and I know you're telling me it's going to be okay, but I feel like I don't really want to. Again, I think that's natural. I think that's human nature. You're, hoping for the best, but also half an eye on the worst. And I think that's then making sure the longevity will work. For us, sometimes it's finding that balance to say to people, okay, some people are spending too much, some people are spending not enough. We're trying to find that Goldilocks sort of middle area. Sometimes it's a case of they've had a sort of a bias from parents. Again, I've got lots of clients who say, well, we want to save every penny and we don't want to spend every penny because that's how my parents have brought me up. Again, they think about their own kids where they're going to try and leave a legacy as much as possible. And for me, that's completely fine as long as it's their active decision and it's their objective. And you're trying to balance what's gone before. Again, things like Northern Rock in recent history. Sometimes people go, what happens if I lose everything? Is there a chance my pension provider could disappear in the same way that someone's bank account could have disappeared in the past? Again, working through that with people to say, okay, well, even if a pension provider went bust, your money's not actually on their balance sheets and it can just be moved to another provider. Again, give someone the peace of mind to say, okay, for you, I don't have to worry about that. Obviously, we see clients who have cash accounts that are spread thinly because of the FSCS protection limit. Again, you don't have to do that with pensions, and talking that through with people really helps reassure them that their financial risks are being covered.
Yeah, absolutely. Another thing that we see quite common with sort of people at retirement, and actually, to be honest, investors throughout their life, is that sort of fear of missing out or following the crowd. Particularly, we'll see it quite a lot at retirement if there's clients that are all in sort of a friend group that have maybe referred one another, and a lot of them are going one route down retirement, and then the person's feeling pressured to go the same route down retirement, and maybe we've sat down with them and going, look, that was right for them, it might not be right for yourself. And I suppose it's that importance of getting a different perspective to see if it is right for you and work out what your priorities are.
Yeah, I think that's spot on. I think everyone's got unique financial position, and you could have sat next to someone at work for 40 years, but you could still have completely different finances. And I think sometimes you do need to have that almost sense check to say, so-and-so's doing that, but that's not right for me. Again, we specifically see that with psychology of risk and the level of risk that someone's willing to take. If someone's really committed to investment and is happy to take volatility, drawdown can be the perfect answer. They could sit next to someone who's a lot lower risk, who's got more assets potentially or no debt, and something like annuity can be the perfect choice for them. So again, not just following the crowd certainly makes sense. I think FOMO is also massive, the fear of missing out. And we often have people going, okay, the world's a bit more volatile at the minute. How do I reduce risk, but I also want to benefit when the markets go up? That's the same thing. That's the almost, I want my cake and I want to eat it. And that's where you have to stay invested, because you can't, as Joe described earlier, you can't miss the best days. And therefore, you can't then say, oh, well, I want to miss some of the volatility now, because you can be hampered. So I think that's definitely relevant. But we can almost see FOMO the other way. It's opportunity, and you might say, well, if I stop spending now, or if I don't retire now, maybe I have missed out, and I can't have that years back or those time back. So it's a really interesting one. And I find, retirement is psychological. We often talk to clients about being financially ready and psychologically ready. And sometimes it's that fear of retirement where people go, society tells me I should retire and I want to retire, but I haven't actually quite got a clear picture of what my identity and my purpose and my time looks like. So it can actually be quite an uncertain step. So we encourage people to think about their bucket list, to think about their time, and to get excited about retirement. And that then makes retirement a lot easier. I don't worry about someone who plays golf in retirement or sings in a choir or does things that starts to fill their time, because that can be perfect. Again, granddad's taxi is another common one where someone starts doing that and they say, I'm busier than when I was first working. So for me, I think there's lots of psychological bits to unpick, but I think sometimes a financial planner who's done it all before with lots of people can help work through some of those common issues.
Yeah, I mean, with regards to that and sort of the benefits of a financial planner, a couple of episodes ago, we did talk about sort of that Vanguard study, Advisor Alpha, and they attribute 1.5% to behavioural coaching of a financial advisor.
I think it might be more.
It might be more, but the amount of times where you'll have a client or you'll speak to someone where they go, I know it's the right thing to do long term, but, and then they're stressed or don't feel like it's the right thing right now. And a lot of the time it is just reassuring that the financial plan is there and that we've looked at this and we've planned for this, and it's just about sticking to it on a longer term basis.
Yeah, one of my clients recently said to me, I know what you're going to say, but I just need you to say it just to reassure me. And I think that's the perfect message. It's that element of, we're here, having done this before, having, got all the information. We get economists and fund managers feeding into the process, and we know what someone's objectives are, so we can say, actually, this is still the right thing to do. And like that lady said, I just need you to sort of go through that process, so I know that, the Telegraph's doom and gloom story isn't, what I need to worry about. Actually, I need to carry on with my plan. I need to keep going. And actually, that's more important than panicking and changing. Again, panic and fear is natural, it's human nature, but actually in the moment, in a market event, you think it's the worst thing you've ever seen. But as we described from some of the data, actually it happens quite regularly. I was reading a study that said, going back to 2009, there was something like 74 events in the US that had caused market panic attacks. And again, some of the big ones were COVID, the Brexit vote, but there was other things like Evergrande when that ship was in the canal sideways. Again, when was the last time you thought about that? That was something that appeared, was an issue. Markets were a bit choppy, and then it disappeared and was resolved, never to be thought about again, apart from when I look at it and it's on that list of panic attacks. So I think it's perspective of coming through these events and actually seeing the impact of it. COVID was the perfect one, where the FTSE, the UK equity markets fell by more than 30%, but actually, like being punched in the face, the markets fell on the floor, and then when they realised all the companies of the world weren't going to go to nothing, markets quickly recovered, and we actually ended the year in a positive position. And I think that's the perspective that people have to have, that when they're investing for the long term.
Yeah, absolutely. So I think I'll just sort of round up with a few sort of key takeaways of the episode with regards to behavioural biases. I mean, the first one is everyone's human. Don't feel like because we've talked through something here that it's wrong to think it. But crucial thing is to have a financial plan, whether it's through a financial advisor or yourself, just so that you can almost revisit it when you are struggling and you understand that it's there. One thing that I find quite useful with clients is almost try and automate as much as possible. So if it's a regular investment that you're putting in, put it in on a monthly basis so that you experience the ups and downs each month, and are buying at sort of lower prices and higher prices, so you're not taken back by shocks.
So it takes away the almost active decision and makes it automatic, so you don't have to say, I'll hold off now, and then you're not sure when to do it.
Yeah, absolutely. For example, people that with the new tax year might have come in planning to do 20,000 in the new tax year into your ISA allowance, but if you just set that up as whatever the monthly is, 112, 16, 66, I think it is, each month, then you get there. I'd say limit how much you check, still be available, but sort of limit how much you check your investments, and I suppose maybe don't focus too much on the financial news. And then at the end of the day, I think it just comes to come in, make sure you've got someone who's accountable, that can help make you, accountable, whether it's a financial advisor or just someone else that you know, just so you can get a different perspective on things.
Yeah, and I think the other thing I would add to that is don't act differently during a time of market, volatility, unless you feel like you can take less income, for example, and allow your investments to recover. Carry on having the holidays, carry on enjoying retirement, because that is why you started the plan and that was factored into it. And I think, part of the world can be a choppy place, but we can help people navigate through the emotional feeling of those investments, to stop, to lose the sort of euphoria and to lose the panic, and to almost have that happier middle ground.
Yeah, absolutely. So I'm pretty happy with everything we've covered. If you've got any questions with what we've covered in the episode, leave them down in the comments and we can answer them there, or potentially do a full episode on them. We've got new episodes every Tuesday as always. Thank you very much for watching, and we'll see you next time.